With the Standard & Poor's 500 benchmark hitting all-time highs again today and other key indices across Wall Street doing similarly well, many asking why and where now. Duncan Lamont is the head of strategic research at Schroders here in London and joins us now. Duncan, welcome. We've just been talking off camera about today's trade. It's not just the S&P 500, the Dow, the Nasdaq, the DAX, the CAC, the Nikkei 225. We've got risk assets being pushed up pretty much across the board. What's going on? Why are we adopting so much risk given the fact that interest rates remain at recent record highs?
So I've done some work looking at how the US stocks perform if you look at different cutting cycles in the past. And I've used data going all the way back to the 1920s. So it's almost 100 years of data, 22 interest rate cutting cycles. And what you find actually is when we go into that cutting cycle, and the market is clearly anticipating that right now, stock market typically does very, very well. The average 12-month return after the Fed starts cutting interest rates is 11% ahead of inflation. The average return on cash, 2% ahead of inflation. So there are a lot of people who are looking at these numbers and thinking interest rates are going to get cut. Historically, that has been a fantastic time to be investing in the stock market.
Okay, so that's markets working efficiently. They're pricing in the future, which is what markets do. The big question is with us now at record highs, are they overpricing expectations?
So you'll be pleased to hear I've also done some work on that. So again, I've done almost 100 years of data looking at how did the stock market perform in the 1, 2, 3 years after it has hit an all-time high. Now, I think if you went and asked 100 people in the street, do you think it is better to invest when the market is at an all-time high or better to invest when it's at some cheaper level? Most people will think cheaper. Yeah. Historically, actually, the average 12-month return after an all-time high has been higher than the return if you invested at any other time. So rather than being a bad time to invest, historically it's been a great time to invest. And it's counterintuitive, but it's actually because the market goes up over time. So it hits all-time highs all the time. 30% of the time it's at an all-time high. And there is that momentum effect which typically goes through.
Let's bring up a chart of the S&P 500 to show us, remind ourselves of what happened. Last year on the 24-hour markets, on the IG platform, we recorded a 23.25% rise. Since the beginning of this year, we're up 10.25%. Now, this is a continuation from the lows that we saw back on the 26th of October, and that's a fairly good, reliable, solid channel. It has moved up tremendously over the last 24 hours or so since the Fed interest rate decision not to move, but potentially pricing in 3 cuts this year. There is, I guess, a point at which we say enough's enough, but this is a hefty move given we're only in the first quarter of this year so far. Are you worried about the breadth, or rather lack of breadth, of this rally that we've got? Because we hear a lot about some really big stocks that are doing a lot of the heavy lifting.
Oh, absolutely. So if we look globally, since the start of 2023, the magnificent 7 of Apple, Amazon, Alphabet, Nvidia, Microsoft, Meta and Tesla, I think I've got 7 there, they're up 94% collectively. The rest of the global stock market, so every other company on the MSCI All Country World Index, collectively are up 20%. So the heavy lifting is coming from those stocks. Those 7 stocks, and this is possibly one of the most astonishing statistics I can remember for years, make up more of the global stock market portfolio than the next 5 biggest countries added together. So 7 stocks bigger than Japan, UK, China, Canada, France added together. So there is tremendous concentration risk. What that means, if you look at headline valuations, particularly for US stocks, they look expensive, whether you're looking at price earnings multiples, price to book, cyclically adjusted price earnings. But actually, if you look at the average American company, they're not actually as expensively valued. So there is a cohort of stocks which are trading on expensive valuations because, let's be honest, there are huge expectations for what these companies are going to deliver. This isn't .com hot air. These are brilliant businesses. But actually, many other companies are actually trading on much more reasonable valuations. So I think that we can get taken in by the headlines and make you think that everything is expensive and this is a bad time to invest. There's fantastic opportunities out there.
So we haven't missed the boat. I mean, that's the next big question. Those that haven't been able to take part in this for whatever reason, coming to the headlines now thinking, crikey, I've missed it. What's the message to them?
Yeah, my research shows that when the market hits an all-time high, the next 12 months, it is more likely to go, the average returns have been higher than if they're not an all-time high. So there may be reasons for people not to like stocks right now. It absolutely should not simply be the fact the market feels like it's at a high level. That has not been an indicator of what might happen.
So given the fact we've got a fairly high concentration in a very small number of stocks, when the reverse, and assuming it does happen at some point, I mean, nothing ever moves up consistently forever, when the hot air or the expectation or whatever reverses, is taken out of the market, do we see a big slump, or do we see a drop that just represents some of the air taken out of those Magnificent Seven stocks, and does everything sort of remain where it is because they're fairly valued? How do you see the next few quarters developing?
So I guess you have to think also to thinking again about this rate cutting cycle. Normally central banks are cutting interest rates because they're worried about the economic outlook. Growth is too weak. There's concerns about unemployment being too high. They're cutting to stimulate. That's not the world we're in today. They're cutting because policy is seen as not needing to be so restrictive. Inflation is coming down, it's coming under control. So that leads us almost into this soft landing scenario, which is actually potentially very good for stock market investing and very good for bonds as well, actually. It could be a year where both go on to do quite well. What some other work I've done has shown is that when you have these periods of high concentration, in the next 5 years, the equal weighted version of stock market indices typically does better than the market cap weighted. In kind of more plain English, what this means is you would do better by deviating from the benchmark. It is hard for those mega stocks that have become so concentrated to keep being the engines of growth. Historically, it's been more likely there has been a broadening, and actually there would have been better opportunities to be looking in some of the other parts of the market, including other countries, I would argue.
Okay, so let's take the situation. We've got interest rates coming down, and then all of a sudden, a little bit of heat starts to return to economies. Demand goes up. So do oil prices. Oil prices are a big driver of inflation. Inflation comes back, we're then back to square one, aren't we?
Yeah, so actually, one of our strong views is actually that inflation and interest rates are going to be structurally a lot higher than people have grown used to for the past few decades. We've got these three big trends of deglobalization, decarbonisation, and demographics. All three of those are actually going to put upward pressure on inflation. You've got a smaller workforce, which actually then means that wage pressures are going to be higher. You've got companies that are making the supply chains more robust. It's not just about the cheapest location, it's about resilience. So then you're actually increasing the cost of your supply chain. You've got decarbonisation, where companies are investing to actually prepare for a kind of more uncertain future when it comes to climate change. All of those are inflationary. All of those lead to interest rates being higher. So I think that we all have to sit up and take notice that we're not going to be going back to the world we were in the past. I don't think that has to derail the story for equities right now. I think that equities can continue to do quite well in that environment. You might want to look more at some real assets as well. So which assets might have, in that no landing where inflation stays higher, which markets, which sectors, which asset classes might have some inflation protection built into them, which could be more valuable.
So you're saying that'll be the area that people ought to focus in on for the next upward cycle?
I think it is one of the potential scenarios that it would be naive to assume that actually we're just going to go to inflation back at 2%, interest rates come back down, and actually, happy as Larry, we can move on. I think we should at least be aware of some of those risks, and then think of assets such as commodities, where there can be some more inflation protection and actually can build a bit more robustness in a portfolio. Maybe I'm slightly old-fashioned. I just think that diversification makes a lot of sense. I think you want to be thinking about what are all the things that can happen, and how can I actually build a portfolio of assets that will mean it's robust, and even if I'm a little bit wrong in something, the wheels are not going to fall off my portfolio.
Just one final question, and because you've done this research over multi-decades, and of course the US markets we referred to because they have such long data, which is easy to work against. Does your research bring up anything about black swan events? Because I'm asking this because there is always the unknown around the corner, be it COVID, be it the great financial crisis or whatever. Heaven forbid something developing with Russia and Ukraine and China and so forth. And of course, that brings about possibilities of all sorts of unthinkable events. How do black swan events impact on stock market performance? So,
important point. A lot of the numbers I've used quoted today are averages. The ranges are wide. Stock market investing there is risk associated with it. And although these are, on average, stocks do well, whether it's a recession, whether it's not a recession, when the Fed starts cutting interest rates, although stocks on average do well when it's at an all-time high, there are clearly situations where that does not occur. That is the price of the entry ticket for the stock market, I'm afraid. Like the one thing that I feel most strongly about is probably, if you're waiting for the perfect entry point, you could be waiting forever. It is much better to be having a disciplined approach to investing. If you ever think about going all in or all out, the odds if you get even a little bit wrong in that, it could be very painful. Whereas being more systematic and disciplined, investing over time, is just going to lead to more robust performance and less chance that our behavioural chimps get in the way of some of the decisions that we might otherwise be making.
Interesting. Look, it's a fascinating subject. Thanks indeed for joining us. It's really interesting to see what the context is, as much as anything, in where we've been. So our thanks here at IGTV to Duncan Lamont, Schroders Head of Strategic Research, in his look at the markets as we see these recent record highs continue to tick up.